we live in a world in which policymakers are naturally rather timid. They prefer to sort of patch up cracks in the banking system rather than deal with fundamental flaws. Bankers themselves, although much discredited, still hold a lot of power, and they want to preserve the status quo.
Welcome back to BVTV, brought to you by PGIM, Peter Farlarsson, the global editor of Reuters Breaking Views, joined once again by Eddie Chancellor. Eddie, welcome back to Breakout.
I see you, Peter.
So Eddie, so as you've written about a lot, there are many problems in the economic and financial world. We've got inflation, we've got interest rates rising, we've got huge amounts of debt, we've got banks getting into trouble. And you've written a column for us this week about an idea that could take away all of these problems with one big sweep. Tell us how that would work.
I look at, think in the early 1930s, we had, a Great Depression, and some of the world's greatest economists, Irving Fisher of Yale University and Frank Knight of Chicago, came up with an idea that's now known as the Chicago Plan. And the idea was really that the problems of deflation and bank crises could be removed if the banks no longer created money by lending out deposits. So what the Chicago Plan suggests is that you replace bank deposits with a state form of money, and that state form of money would then increase at a certain percentage point amount each year, and it would keep the price level stable. So you'd have a more secure banks, you'd have a stable price level. And there was another advantage they found, which is that because the new state money in effect would be swapped with the banks for their holdings of government bonds, but wouldn't pay interest itself, there would be in effect a massive decline in the cost of servicing the government debt. So it dealt with a number of different problems all at the same time.
Sounds very appealing. And so fast forward 90 years. Obviously, there are no new ideas in finance, but someone, Thomas Meyer, the former chief economist at Deutsche Bank, has sort of reinterpreted this idea for the digital age. But how does that work?
So Thomas started, I think, by thinking about the question of the central banks introducing a central bank digital currency. And as you know, one of the problems with that is that the CBDC would then compete with bank deposits and suck money out of the banks, which would actually probably create a really severe financial crisis.
Because this would be a completely safe currency, right? It'd be something issued by the central bank. Yeah,
it'd be like a treasury money market fund or whatever. So what Thomas is saying is that the central bank should issue a CBDC, but that CBDC should replace the deposits in the conventional banks. So the banks would basically get out of the business of lending out deposits, and the deposits they held for their customers would be in the form of the state money in the CBDC. And once again, the CBDC would increase, the money supply would increase at a set amount, so you'd control inflation, and because it wouldn't pay interest, it would also lead to a decline in effect of the cost of government debt servicing. So it would bring the same type of benefits on paper.
So okay, and then I guess the other thing that then comes up is what happens to regular bank lending, where if the banks are basically accepting these CBDC as deposits and putting them in sort of government bonds or whatever, then presumably all the lending has to take place somewhere else, does it? Mortgages and corporate loans and all those things.
So, Peter, as you know, since the global financial crisis, when deposit rates went down to zero or close to zero, a lot of money, a lot of more lending has taken place outside of the banking system in credit funds. Apollo, for instance, has big credit fund business, and a lot of other people in that business. So, in effect, you'll be growing the credit funds and the banks themselves, if they continued lending, they would become a bit like a credit fund. They would have to borrow. They'd have to either use their own capital, or they'd have to borrow, cash in the market, and then use that cash. But what they wouldn't be able to do is to use deposits for loans, which is sort of where most of which is, in fact, the flaw in modern banking that has been observed for more than 100 years, but we've never done anything about it.
So I mean, so back in the 1930s, as you write in your column, the architects of the Chicago Plan presented it to President Roosevelt, who considered it and then decided not to do it.
Yes.
Do you see any more likelihood that some president or government minister might be more willing to adopt it this time?
Not realistically. I mean, in fact, actually, because the banks are sitting on massive reserves with the central banks, it would actually be much easier to make the conversion now. And as Thomas Meyer points out, this would probably save the Eurozone from all its sort of existential crises, which are always just around the corner. And another point he makes is that it would actually mean that interest, and we know central banks get a lot of criticism for setting the wrong interest rate. Interest rate would be set by the market. So there are a lot of attractions, but we live in a world in which policymakers are naturally rather timid. They prefer to sort of patch up cracks in the banking system rather than deal with fundamental flaws. And obviously, bankers themselves, although much discredited, still hold a lot of power, and they want to preserve the status quo. So I think I spoke to Thomas earlier this week, and he's not very sanguine about his plan taking off. He says that since he first aired it, there's been very little interest, and he says it can really only probably come about after a complete collapse of the financial system, which is a slightly worrying thought. His comment is his CBDC is like a digital Rentenmark, the German currency that was introduced in November 1923 to stabilize the German monetary system after the hyperinflation. So until we get to that point, we can expect more bank failures and price instability to come.
Well, that's a cheery thought to consider, but very interesting as always, Eddie. You can read that column and many others by Eddie and others on breaknews.com. And we'll talk to you again soon. Thanks very much.